There's no polite way of putting this, but I would be shitting myself if I was a property investor. And by property investor, I mean someone who owns more than one property. The more properties, the worse it would get. If you got the portfolio of properties and you think you're so smart, you made so much money on paper in the last 10, 20 years, think again. Please watch this to the end. There's so much good content.
There are more signs the great property market slowdown is starting to bite. Building supplies company CSR has shut down one of its bricks kilns in Sydney and cut back shifts at its Western Australian plasterboard facility, as its share price has tumbled more than 40% since the recent peak. But CEO Rob Sindel says the property market is in an orderly correction, not a crash. I spoke with Rob Sindel earlier.
I mean, I've stopped videos in the past when people whose vested interest is for property to continue to go up. I mean, they sell bricks. And they've just closed the brick factory and they've reduced shifts in another one. The share price dropped 40%. You know what that means? People are shorting because it's very hard to actually short, meaning make money on a dropping market. It's very hard to do it. In Australia, there's no CDOs or financial instruments where you can buy into to cash in on a dropping market. Instead, you can what's called short banks or brick companies, other building suppliers, and this is exactly what's happening. So the share price dropped 40%. What do you think that means?
Rob Sindel, thank you for joining the business.
Pleasure, Carrington.
CSR shares are down another 8% today, down 40% since their recent high. Is this investors betting that the housing downturn has begun?
I think that's obviously the reason that people are worried that how far does it fall, how far does it roll over. We're still seeing good activity, as you saw from our results today.
He's seeing good activity. How is he seeing good activity when the share price is down 40%? All right, that's the market betting. Share price does not necessarily have to follow the valuation of the company or how well the company is doing, but they closed the factory and they cut down the shifts of the factory, and obviously the CEO has to spin it positively. I mean, you've got to see through this if you're a 6-year-old.
But it obviously has come off its peak. Where is the pain most acutely felt?
So I think in terms of the overall market, it's multi-residential, so it's down about 25%, and that's high-rise apartment construction in Sydney is down about 25%. But we're not feeling undue pain because that's about 12% of our revenue. Our real sweet spot is the detached market, and even that's some of the concerns that there's some softening in the detached market in New South Wales, but the rest of Australia looks reasonably good.
There's some pretty bearish predictions, particularly around house prices.
Yep.
Shane Oliver from AMP predicting there'll be a 20% fall from peak to trough.
Yep.
That obviously feeds into how many more houses people want to build.
Yeah.
What is your prediction about how deep this is going to get?
Well, I've seen some of those predictions, and I think it doesn't change the number of houses we need, because with population growth...
Oh, and I've stopped videos before when people drop a population growth bomb. And one of the viewers made a comment and said, where are all these people going to live? And my comeback to that is they're going to live in the same house, same apartment that they lived before, except that now they're not going to pay $1 million for it. They'll pay $600,000 for it. Simple. They'll still be there. They just won't be valued that much because people just can't borrow as much as they used to.
380,000. It's you've got 150,000 houses required to meet that, and you've got about another 45,000 of knockdown rebuild. The demand doesn't change so long as that population growth. What changes is confidence, where it says actually, and that 20% drop, a lot of that's in the established market. In the new build market, it's saying, well, actually, do I build a house and buy a piece of land today, or will it be cheaper in 6 months' time?
And he's hitting all the good points, but then he spins it into something better. Well, the good point is that when the velocity of money slows, when money changing hands, when the deflation happens in all the markets, they happen when people lose confidence. When people think that they can get something cheaper tomorrow, if they just wait, they're going to hold on to the money. This is when the deflation happens. This is when not expansion, but deflation happens in any market. The confidence is lost. So clearly people are thinking, and everybody I've spoken to, everyone's thinking, whether you think it's going to be 5, 10%, 4% or 40% drop, you know, in your own mind, your confidence tells you that you're going to be able to buy that property that you're looking for cheaper. So you're going to buy it today, or you're just going to sit on it and wait it out? I think the latter.
I think that's more a confidence issue than a supply and demand issue.
It might not change that demand in that people might still need a place to live, but it does seem that a lot of the price action was led by speculation, that people were betting that there was going to be bigger and bigger house price rises. Now that that has turned, are you predicting we're going to see a huge slowdown in construction?
No, I don't think there is a detached market. I think you've also got the investors at play here. You've also got what is the Labor Party policy around negative gearing. So investors are stepping back. That in a funny.
So he doesn't think. I'm gonna stop making comments in this interview and move on to the next one. But he doesn't think it's gonna make any effect. But people will stop buying because of the Labor policy, and it's not going to be as attractive. And not to mention, even if they want to buy, they can't get the money from the bank. I mean, he kind of says, yeah, I agree with you, but no. Then he contradicts himself. But hey, he's the CEO of a brick-making company, so of course you're going to be saying that.
The battleground over negative gearing and capital gains, sorting fact from fiction for investors. And the canary in the construction coal mine, building supplier CSR, on how hard the housing slowdown will hit. With the federal government's future looking shaky, investors are focusing on Labor's promises to wind back negative gearing and capital gains tax concessions. Property lobby groups are warning of a $12 billion fall in the market if the policies go ahead. But tax experts say the current concessions are too generous, and it's a good time to introduce the changes. Here's finance correspondent Philip Lasker.
There aren't too many things more important to vet Lauren Bajaya than animal welfare.
Wonderful. He looks pretty healthy. How old is he now?
But securing her future is also vital, and she sees Labor's plans to reduce tax concessions for property investors as a threat.
They may reduce my actual ability to purchase property and to hold it for the long term, and it also may reduce the actual growth in my properties and my ability to fund myself in retirement.
The government's approach from the former Property Council employee and now leader has been harder hitting.
That would be taking a sledgehammer to the property market, and you wouldn't have a safe landing, which is what we're moving towards. You'd have a crash landing, or you have a hard landing.
So you'll have a crash landing if Labor comes in power, and it's looking like all the polls are saying it will. So, although it's a prime minister, he's a politician, so you have to take everything they say with a grain of salt.
2 years ago, as big city property prices boomed, Labor announced plans to cut back on negative gearing and capital gains tax concessions.
Removing a tax break for investors helps make it more affordable for owner-occupiers and first-home buyers. Secondly, it helps with financial stability.
Labor will cut the capital gains tax discount from 50 to 25% and scrap negative gearing for established properties, but the changes will be grandfathered, and investors will still be able to negatively gear new properties.
And you know what's going to happen with those new properties? You'll have to go buy in the sticks, and nobody is going to want to live there or won't be able to afford it again. And people who do end up living in those new areas, greenfield areas, will still continue to live there, except that they're not going to be paying all these ridiculous prices. Again, that's my prediction. Not a financial advice, just my opinion and prediction, and I'm standing by at peak to trough, 40%. Continue on watching, please.
Master Builders Australia argues that the tax changes make property investment far less attractive, despite the exemption for new dwellings, a dangerous policy in a falling market. But Labor is not for turning. The Tax Institute welcomes plans to cut what it sees as an overly generous capital gains tax discount, which is simple to implement. On the other hand, the negative gearing changes are more problematic.
Want to hear crickets?
Who'd like to commence the bidding this afternoon? Homes here to be bought.
But buyers are in short supply. House prices are falling, fewer loans are being written, and the days of stellar bank profit growth are over.
Borrowing capacity is reduced, investor lending is stalled, and competition increased.
Oh, by the way, that dire prediction, 3-point prediction, comes from none other than Shane Elliott, who is ANZ Bank's CEO. And the last piece of the puzzle for tonight, for you.
National property values have continued to slide, down 3.5% in the last year, the biggest pullback since 2012. Sydney was down 7.5% ahead of Melbourne, which lost 4.5% in the last year. Perth and Darwin are down about 3%. Most other capitals recorded slight increases.
Clearly, people's borrowing capacities have been trimmed, and that's forcing values lower, and doesn't look like anywhere in the near future that those trends are going to reverse.
Hobart was the strongest performer, up 15% in the past 12 months. That's all from the business.
Yay, let's all move to Hobart. I'm not sure what we're going to be doing there, except the beautiful nature, scenery, clear skies, maybe clear air, more like it. In any case, thank you for watching, and I'll talk to you in the next one.